the ultra-loose monetary policy. The BIS in June has said that central banks should not consider short-term effects of their monetary policy. They should be looking at long-term effects of their ultra-loose monetary policy. What we see is the willingness to accept risk has increased, but the desired effect has not happened. The desired effect is increased investment. And increased investment hasn't happened. Increased investment in factories and other real investment, that has not happened. So from a German perspective, this ultra-loose monetary policy provides us with risk, but it doesn't provide the reward that many have been expecting. At the same time, the low level of interest has contributed to a false sense of security, and many countries in Europe have reduced their willingness to implement reforms for higher productivity. And that is a big negative side effect of that ultra-loose monetary policy. Countries think they get away without reforms, and that is not true. Alan Meltzer from Carnegie Mellon has been suggesting that QE is a trap. It's easy to enter, but it's very difficult to leave, and we already do see that. He has been suggesting that US monetary policy, US economic problems cannot be cured by monetary policy. The same applies to quite a few countries in Europe. If you look at Italy, Italy has deindustrialized in the last 25 years. In 1990, Italy produced 2.1 million cars. In 2013, they produced 400,000 cars, fewer cars than Slovakia, fewer cars than Iran, and fewer cars than Argentina. This deindustrialization is at the core of the problems in some European economies, and monetary policy does not contribute to the solution. So that is in a position some in Europe have. The ultra-loose monetary policy has also contributed to a further inflation of debt levels in the global economy. We're just looking at the time from 2008 to 2013. Global debt rose from 174% of global GDP to 212% of global GDP. That is excluding financials, and that is unhealthy. It's particularly unhealthy in China. In China, Chinese debt has grown from 150 to 220% of GDP in those few years. Debt has grown faster in China than GDP. And that is, of course, a warning sign. We should be very much aware of these risks. So ultra-loose monetary policy has contributed to a rise of debt levels, and that is a problem. Second point, what will happen after quantitative easing? A German perspective is the sooner it ends, the better. It will always be problematic, but the longer you postpone the departure from QE, the more difficult it will be. It has already been said, turbulence is unavoidable. The question is how to manage that turbulence. We have seen last week that a previously rising star, Brazil, was downgraded to junk by Standard & Poor's. That shows you that some of the problems we face at the moment. The difficulty is that the potential end of QE coincides with the deteriorated perception of the BRICS countries, with the potential exception of India, I may add. For the resource producers, I don't think we have seen the end of the decline yet. Goldman Sachs last week predicted that oil may be going down to $20 a barrel. It's not easy for the US. It's not easy for Russia. As a footnote, the very recent willingness of Vladimir Putin to stop making trouble in Ukraine may be driven by that decline in the oil price. I'm just speculating, it's just a footnote, but it, of course, will result in problems for the producers of oil. it will perhaps result in a defracking process in the United States. It's already difficult for the fracking industry to mobilize additional capital, and at $40 a barrel, they can't make a profit, let alone at $20 a barrel. So we will probably see an appreciation of the dollar, and this is, of course, a big issue for US policymakers. We have seen a kind of a little bit of a renaissance of manufacturing in the United States of America. And when the US had the last kind of strong tightening phase in monetary policy in the early 1980s, when the dollar rose from 1 Deutschmark 70 to the dollar to 3 Deutschmarks 47 in 1985, this was a shock to US manufacturing. The question is, can the US, and is the US willing to do something on that proportion again? I think it would be a very good idea if the big economies would tighten monetary policy together in tandem. I think it is not necessary that all central banks tighten at the same time, so emerging economies do not have to be part of that process. But I think it would be very useful if the Fed, if the European Central Bank, if the Bank of England, and if the Bank of Japan would announce that over time they want to tighten together. If they don't do that, and this is the more likely outcome, if they don't do that, I think we are in for quite some nasty developments in exchange rate, with regard to exchange rate developments. Economic history tells us that a synchronization of monetary policy is possible under the gold standard. It was possible, and I think this is an option for the future. If that is not happening, which I think is likely, then what Mrs. Gupta has mentioned, has labeled the calibration of capital inflows, would in my language be the implementation of restrictions on capital flows is back on the agenda. I don't think that it is possible for emerging economies to insulate themselves against these and against the effects of monetary policy elsewhere without using some moderate form of taxation of capital flows. This is not a first best solution. This is, of course, a second best solution. But the willingness of the big central banks to cooperate, unfortunately, I think continues to be relatively weak. With that, I would like to close. I think I haven't even exceeded my 15 minutes, have I? Okay. Thank you for your attention.
Let me just sort of remind the audience that I'm from the financial markets, and the way I've been seeing things for the last couple of weeks is that we are actually in the middle of a crisis, at least for the Asian emerging markets. So it's not something that, and this could be exacerbated by the Fed's decision. I don't entirely agree with Poonam that it's all sort of priced in. A September liftoff might be construed very differently from a December liftoff and so on and so forth. But I think the way capital has been moving out, particularly from the fixed income markets, the bond markets of Asia, does seem to suggest a sort of a crisis-like situation. It does, feel like a crisis. So is it a bird or a plane or a crisis? We don't know. But let me ask Naoyuki, who's already up there. You have 15 minutes.
Okay.
Yeah.
Okay, thank you. I prepared so many slides, so I have to skip many of them. So this is the overall structure of my presentation, and let's start with the first item, monetary policy in G20 meetings. The question here is, what were the discussions on monetary policy in G20 meetings? To know the discussions, we can have a look at statements or communiques of the meetings. They are not summaries of discussions because drafts of communiques or statements are prepared in advance of the meeting. But we can know that what were the main issues of discussions and consensus of member countries. This one. From this slide, I show you excerpts of monetary policy in communiques. In the first 5 meetings, monetary policy is not mentioned in communiques. In the meeting in 2004, central bank independence was mentioned. The meeting was held in Germany, and it is usual that host country serves as a chair of the meeting. And usually the chair prepares initial draft of the communique and asks for comments from member countries. So the chair then collects comments from member countries and revises the draft. So the chair plays a key role in the drafting process. Stance or views of the host country are more likely to be reflected in the communique. Stress of central bank independence in the communique under the chairmanship of Germany is a good example, but it is not always the case because communiques are adopted by consensus. So when there are diversified views or confronting issues, the chair has to find some compromised wordings acceptable to all the members. In the communique of October 2008, policy coordination is mentioned in the context of financial markets. And then skip those from 2009 to early 2012. Oh. In the communique of June 2012, it is mentioned that emerging market countries expressed concerns that the easing in monetary policies in advanced countries is contributing to an increase in both the level and variability of capital flowing to their economies and volatility in other financial variables. I guess that it says emerging market countries because advanced countries may not have liked this sentence, but not so far as to insist on deleting the wording. In the communiques of February 2013, negative spillovers on other countries is mentioned, and this phrase is repeated in communiques of the following meetings. In communique of July 2013, mandates of central bank is mentioned. This phrase is also repeated in communiques of the following meetings. In relation to monetary policy coordination, it is said that future changes to monetary policy will continue to be closely communicated. The phrase of clearly communicated is also repeated in communiques of the following meetings. And I skip some of them. And this is the most recent communiques issued 9 days ago, which says that we note that in line with the improving economic outlook, monetary policy tightening is more likely in some advanced economies. It just says note instead of concern or other negative wordings. And then it says we will carefully calibrate and clearly communicate our actions, especially against the backdrop of major monetary and other policy decisions, to minimize negative spillovers, mitigating uncertainty, and promote transparency. There may have been heated debate between US and emerging economies, I'm not sure, during the drafting process. But anyway, this is the wording acceptable to all the members. Next, I will move on to the next question. What are the mandate of central banks? This is a summary of United States, EU, and Bank of Japan. And in the case of United States, maximum employment, stable prices, and moderate long-term interest rates are the objectives. And in case of EU, price stability, and also it should support the general economic policies. And in case of Bank of Japan, price stability is the objective, and thereby contributing to the sound development of the national economy. Next, it shows the independence of central banks. Independence of central banks is regarded as important because if there is some political interference in monetary policy, then there is negative side effects. However, there is some contradictions between monetary policy coordination and independence of central banks. independence of central banks and monetary policy coordination may not be compatible. I would like to move on to the monetary policy in the US. Does the US Fed care about spillover effects of normalization or tightening when it decides monetary policy? To answer the question, first I would like to show you the most recent policy statement of FOMC, which says as follows: consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. So those are the mandate. And to assess this, they will take into account a wide range of information, including labor market conditions and inflations, and also it says international developments. So what were the discussions on international developments in the FOMC? I would like to show you excerpts of the minutes of the most recent FOMC held on July 28 to 29. It says, although many continue to see some downside risks arising from economic and financial developments abroad, participants generally viewed the risks to the outlook for domestic economic activity and the labor market as nearly balanced. And it also mentions that possibility of adverse spillovers from slower economic growth in China. And next slide is just a continuation. It also mentions a slowdown in Chinese economic activity could pose risks to the US economic outlook. And then it says some participants also discussed the risks that a possible divergence in interest rates in the United States and abroad might lead to further appreciation of the dollar, extending the downward pressure on commodity prices and the weakness in net exports. So in this last sentence, it says that some participants, so which suggests that it is not a view, or it may not be a view of the majority. Oops. So next question is how the US Fed care about foreign economy. I cited here a recent speech by Vice Chairman Stanley Fischer, which is very interesting. He said that in making their policy decisions, they are interested more in where the US economy is heading, and that is the reason why they need to consider the influence of foreign economies on the US economy. And that is why they follow economic developments in the rest of the world as well as the United States in reaching their interest rate decisions. And they are following Chinese development of Chinese economy. And then he said in the next part, he said, I'm well aware that when the Federal Reserve tightens policy, this affects other economies. The Fed's statutory objectives are defined in terms of economic goals for the economy of the United States, but I believe that by meeting those objectives and so maintaining a stable and strong macroeconomic environment at home, we will be best serving the global economy as well. So, sorry, I didn't. So the speech can be interpreted as follows. Influence of foreign economies on US economy should be considered, but it may not be necessary to consider influence of change of monetary policy of US Fed on foreign economies. Instead, he says that he believes that by meeting objectives of the Fed and so maintaining a stable and strong macroeconomic environment at home, they will be best serving the global economy as well. So that is the view of the US Fed. The next topic is the experience of monetary policy coordination in the G7. Before the creation of G7 meeting, there was a G5 meeting, and G5 issued so-called Plaza Agreement in September 1985. it is called Plaza Agreement because the meeting was held in Plaza Hotel in New York. And the agreement says that large imbalances in external positions poses potential problems, and the United States has a large and growing current account deficits, and Japan, and to a lesser extent Germany, large and growing current account surpluses. So, so they agreed that some further orderly appreciation of the main non-dollar currencies against the dollar is